Good afternoon, everybody, and welcome back to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, joined as always by my good friend and colleague Todd Anderson. How are you doing, Todd?
Well, Peter, how are you?
Doing great. And back, I don't know, for fifth or sixth time, delighted to have Ron Shevlin of Cornerstone Advisors. How are you doing, Ron?
Doing great, guys. Thank you very much for having me back.
Okay,
Of course, always great
course.
to have you.
Yes, indeed. So we're going to kick it off with Chime. There was an in-depth article on them in the information this week, which caught our attention. And Chime, like like in some measures, they're doing very well, over $1 billion in revenue. The growth has slowed somewhat, and there's been a lot of talk. And I think I've heard you write about this, Ron. About the fact that the interchange model is really hard to make a profitable neobank out of that, just that alone. They're doing some things in lending, but they are trying to focus on profitability now. So anyway, maybe Ron, you can kick it off and just give us your thoughts on the piece and how Chime's doing right now.
Yeah, I got to tell you guys, I am still kind of bearish on Chime.
Mm-hmm.
It's not just a matter of interchange, which of course is tough. It has a lot to do with their target market, which has been traditionally low to middle income consumers. There's a reason why they are often considered to be underserved, because they're hard to make money off of. And I think and I wrote about this last year, maybe even the year before, that for Chime to really make money in that and become profitable is not about cutting costs by any stretch of the imagination, which of course they could by reducing some of their huge marketing costs, but it's about revenue diversification. It's going to be a tough market for them to lend to because they're low to middle income consumers. But if they have a good relationship, more of a lifestyle provider, and providing other types of services, and they might not even be money related, but they could be money related, like credit card monitoring, and could even be a lot of protection type services, data breach protection, things like that, even cell phone damage protection. There are banks and credit unions offering those types of things.
Mm-hmm.
And these are the kind of services that consumers already buy and pay for, and getting it bundled with a checking account or a payment account is one avenue that they can go to. I don't see them making any move into it. And so I can continue to be kind of bearish.
Right. Todd?
Considering they've been around 11 years, it feels, a little, I guess, strange or interesting that, it's kind of, they've reached scale, and then it's like, okay, that there hasn't been like this larger plan beyond reaching scale. It felt like, they went into the pandemic and they were like perfectly positioned for that period of time. But then after that, it just feels like there's not much else there. And
Right.
it's like, all right, our plan worked in terms of we've reached scale, we've helped this consumer, and then there was no other plan beyond that. And it's the article reads a little strange. It's like that was their entire intent, was let's just reach as many people as possible, and hopefully it works.
Well, I mean, you got to think they're going to have an expanded product suite at some point. I mean, they're the largest of all of the neobanks in this country, and they are going to have to sell more products to these people if they really want to make a large profitable business out of it. But anyway, let's move on. We got a number of AI stories. It is still the topic du jour, and we're going to start off with a piece by our own Isabel Castro that talked about generative AI, and in particular this company called Oculus that has been doing interesting work. I had CEO Sam Bobley on my podcast not that long ago. They analyze documents basically. They started off in the small business lending space and now doing mortgages, really complex documents that have basically hundreds of thousands of permutations. And this generative AI that they have now adopted says it's much better saving them times from human intervention, because Oculus does have a human component to all of these document analysis that it does. And it's an interesting use case, because I feel like generative AI is is a lot of hype and these days, and there hasn't been that many practical use cases in fintech, and this seems like it's one. Todd, what do you think?
Yeah, I agree. I mean, this is going to be. It felt like crypto was kind of the wave for a little while there. Clearly, that has had a lot of limitations. Many of those either self-induced or now regulatory induced. But AI is a whole nother category, and a lot wider and a lot more depth to it than I even think the crypto or blockchain space has seen so far. And I think practical use cases will still continue to come out. I mean, I think this is an interesting one in the lending space, and I think it was interesting they also started with mortgages. If they were able to, kind of deal with the documentation in the mortgage process, it goes to show you that they could probably deal with almost any other lending product documentation. But I think this and the other stories that we'll kind of dig into in a few minutes shows you that AI is here. And there's just so much to be unearthed with AI and financial services, and kind of this is going to be the story probably for the next decade.
Mm-hmm. Mm-hmm. Ron?
I guess this is going to show my age, but to some extent, this all kind of reminds me of like the .com era. I had a buddy who started a company, calls me one day and goes, "By the way, we're no longer called Agility Partners. We're now called Agility.com." And I was like, "You're not at .com." He goes, "Yeah, but we got to call it." So we've gone from that to companies who it's no longer good enough to just be AI powered. Now you have to be generative AI powered
Right.
or chat GPT powered. And I'm not even sure that that's the right label for this, because I mean, look, we've had conversational AI for a couple of years, and my understanding is the real difference between, let's say, conversational AI, chatbots, or intelligent digital assistants and machine learning is the generative AI is about the output. It can
Right.
generate pictures, it can generate code, it can generate music. It doesn't just generate text.
Yeah.
And so I'm not even sure that what Oculus, I can never pronounce that company's name, but the one that we were talking about,
Oculus.
Oculus, yes. I'm not even convinced necessarily that what they've got is generative AI, but the opportunity to better utilize AI-based tools and machine learning in particular in the mortgage space, in the lending space, is absolutely huge. The biggest issues in this space, guys, is not the technology, it's the cultural aspect to this. It is getting the lenders to change their mindset and their processes towards lending to better utilize and rely on the technologies and tools. Because there have been players like Zest AI who've offered some great stuff in the space for the past few years, especially on the writing side. And the biggest issue is the adoption and the cultural aspect to this, not the quality of the tools and technology.
Right. Okay, moving on. A piece by our good friend Dave Birch in Forbes this week was really interesting. He actually was talking about we're at the very early innings. He gave this great analogy of powered flight that happened. I didn't know this till I read his article. 1843 was the first powered flight happened in the UK. But anyway, he's talking about open finance combined with AI, and there's someone that has used the open AI code and was able to kind of use open finance to create, do really rudimentary things like check account balances, view transactions, that sort of thing. But he looks at this as the kind of the very first, it's not the first inning, it's the first pitch of a game where that's going to change financial services forever. I feel like, I really enjoyed the article, and I think Dave Birch is someone we respect. I know you know him as well, Ron. What are your thoughts?
Yeah, I love everything Dave writes, and I think this is an important one because you got to get to the heart of the article, which was about the responses on social media to what this guy, and I forget who it was, that said how he used ChatGPT, integrated it in, and could produce some things, and the responses on social media were just like, this is stupid. Oh, there's always problems. It's just the typical first mover pushback. And I think Dave's point was like, you're really short-sighted if you're pushing back on this. And his comment was, look, this product is not a MVP or first viable product type of thing. It's a demonstration of the ease with which the tool can be integrated in with existing platforms and technologies. And so I think what he was railing against was people's initial reaction to go for the jugular, go for the negative.
Todd?
Yeah, I mean, I think also to tie it back to the first story that we talked about, serving the those that are underserved. I mean, this is where I think a lot of AI-based tools can really help companies better serve a segment that maybe they wouldn't normally be able to in a a profitable way. But the more that we integrate some of these tools and makes serving these customers more efficient, then ultimately you'll get to better services to them, hopefully better rates and all that, ultimately bringing them into the financial system in a more constructive way than we have thus far. And I think this is a constructive exercise, and the way in which people reacted to it is pretty surprising, given how how much we're gonna be integrating a lot of these technologies into our financial lives.
Yeah, indeed. Okay, moving on. Article in American Banker caught our eye this week about JP Morgan Chase wants to create $1.5 billion in value with AI by the end of this year. Now, they spend a fortune on technology. $15 billion this year is they're on track to invest. And there was there was an interview with Laurie Beer, who's the Chief Information Officer at JP Morgan Chase, and just talking about what they're talking about real business impact. A lot of it is cost savings. A lot of it is bringing in additional efficiencies and revenue. So, JP Morgan don't do anything in a small way. They go all in, and because they are such a behemoth, and that is something that I think everyone needs to be paying attention to. Todd?
Yeah, I mean, the big banks figuring out how to use AI to more efficiently either serve their customers or more efficiently run the bank is, I think, a natural evolution of banking. And piggybacking off of the previous two stories, I mean, they're going to find a lot of different ways to utilize AI or index GPT or whatever products they might come up with, to enhance who their customers are and ultimately enhance what the products are that are then being served. So if I'm a credit card customer, I'll be recommended to get a mortgage and recommended to get a savings account. And then I have a kid, recommended to open up a college savings account. And that's where I think the entire ecosystem is starting to go. And banks like JP Morgan spend way too much on technology, especially upkeep. And the more that they can modernize, the more that ultimately is given back to the customer in the long run. I think we're just at the start of it with big banks in particular.
Yeah. Ron?
I think there's a lot to unpack in this article, and to some extent, this article doesn't surprise me, nor does it surprise me what JP Morgan's doing. I think Jamie Dimon has spent a good part of the past 5, 6, even 7 years continuing to complain to Wall Street that JP Morgan Chase should be valued like a fintech, up until last year when fintech valuations hit, and he stopped that game. So now he's shifted to the ChatGPT impact. And this is another one of those, let's throw this up against the wall, pick a number. Okay, $1.5 billion in value. I don't even know what that means. Is that revenue, cost reduction, stock market valuation?
Yeah.
But it's they're basically saying, yeah, we're going to be all in on this. And to me, it's a play for the valuation. I will say this though, I don't know if you guys are familiar with Paolo Cerrone, who works for IBM over in Europe. super, super smart guy. Had a great post on LinkedIn either today or yesterday, talking about ChatGPT and the impact from a financial advice perspective. And he really pointed out something very important, that JP Morgan Chase really focuses on the scale aspect for this. And so therefore is very, pro generative AI because of the ability to create the efficiencies. Whereas you take a UBS who's really more focused on differentiating through human advice and therefore does not see the value or want to see the value in tools like ChatGPT and other forms of large language models. So for me, this is just J.P. Morgan Chase being J.P. Morgan Chase.
Right. Okay, moving on. Another article in American Banker that caught our eye, and talking about the ripple effects of the of all the bank failures that we've seen so far this year. And they listed 10. I won't go through all of them, but some of them are pretty obvious that the chief risk officers are important. Regulatory hammer is going to drop. That's we're going to see some changes there, and the FDIC insurance is going to change as well, most likely. But overall, I think this we are going to see. I mean, regulators typically, whenever there's a crisis, they always like to do something, and usually it's they overreact and go and do things over the top. But we'll see. But I mean, it's a good piece that does provide a lot of insight into all the different things that may come to pass and is coming to pass right now.
I also think it gives a good overview of kind of what's happened and maybe where we're going in some areas, and also highlights things like the deposit switching type services and the networks of deposits that you can diversify with a network of banks, and there's many out there that are either being used or just started being used. And so I think it gives a good understanding of where we are today and maybe where we're headed. Obviously, some of this is unknown, and I think there's still ripple effects that we don't know are going to happen. But I think diversification with your banks, when using the either bank partnership model or I think is important. And we'll see where regulators end up. I hope they don't go too crazy, but those in Congress will probably push them to do something, and who knows what the people in Congress will push them to do. But good overview article.
Mm-hmm. Ron?
Yeah, as you mentioned, Peter, it's a very wide-ranging article. There are two pieces that I want to kind of focus on. One was around, and they did talk, and Todd, you did mention sort of the deposit diversification, but they also focused on just general business, where they said diversify and then diversify some more. And I actually think that's a lot easier said than done. It's easy to look back and criticize Silicon Valley Bank now for being perhaps too narrowly focused on the high-tech market. But last year, nobody was complaining about that. In fact, they were held out as being great examples of knowing their customers better than anybody else. Mm-hmm. And I think for the majority of banks below the top 20, diversify and then diversify some more is actually not very good strategic recommendation, because you have to have good knowledge of the segments that you're going after. So there's a limit to that diversification. The second point I wanted to call out, there was something around, I'm going to pull it up here as I'm looking at it. Another thing that they talked about was banks must be ready to justify anything perceived as woke.
Right.
And I'll let you guys come in. And I had no idea where to go with that one, but that really that caught my eye.
Yeah. Well, I mean, there's basically it's the same sort of thing. It's a social media impact, because someone finds something that a bank is doing and they just go nuts on social media about if it's perceived as woke. And I think, I don't know if regulators are going to be doing anything. I think it's more of a call out to be careful. If you're doing something that can be attacked, then you probably will get attacked at some point. But anyway, want to move on. One of my favorite topics, overdraft fees. And this is really good to see. The CFPB released the numbers for Q4, and overdraft revenue down 50% 50%. I think that's really significant from 3 years ago, from 4 years ago, from 2019, saving households $150 or thereabouts. These are households that really need that $150. There's been, obviously, there's the banks that have either dropped overdraft fees, or like Bank of America, they've cut them. I think, I love the fact that there's a lot of the fintechs, I think, have led the way here and have really shined a light on the fact that overdraft is a bad product. It's a win-lose. And, I think there's a lot of banks that have relied on it for a long time. And I think that, I don't know if the writing's on the wall, but certainly they're not enjoying the amounts of revenue that they were enjoying just a few years ago.
Yep, that's certainly a good point, and I mention this all the time. I mean, a lot of those smaller banks, this was basically their difference between profit and not. A lot of these fees that they charge as you go down the asset size. But I think a couple of things were interesting. I thought in this article was, if it's dropped 50%, regulators are still thinking about ideas here, and I'm not sure. The market has helped itself here. And I don't know if regulators want to go over the top. I know they're talking about maybe changing categorization of fees, and then that comes up against usury caps and stuff. But I think it's a good signal, that the market is fixing this problem. And I also thought it was interesting that banks aren't like trying to come up with other fees to make up for the shortfall. At least some aren't. It didn't, the gap didn't seem to be closing as quickly as maybe we would have thought before, the last few years, and understanding this data a little bit better. So I thought those two things were interesting pieces of the article. And, hopefully we continue to see the fees drop.
Mm-hmm. Yeah.
Yeah, a couple of reactions. Number one, shouldn't be a surprise to anybody. The cutting back of the fees, it's not just B of A, it's all of the top banks, almost all of the top banks that have cut their fees back on it. I know it's tough to take that revenue hit, but hey, it might be better than having Elizabeth Warren up your shorts all the time. So, but the other thing I think is important to recognize here, and why I think there's maybe a longer term impact of this, is that I don't believe that this really represents a fundamental improvement in consumers' financial health. This represents a cut in the fees, not better financial management. So I think we're still early. We got really not sure what the economic impact of the next 6 to 12 months is going to be from a recession perspective, and whether or not the loss in fees is going to have a longer term revenue impact on the banks, who will eventually find other ways to recoup that lost revenue.
Right. Okay, moving on. There was the OCC has basically put out, this was late last week, I believe, put out sort of a guidance, I guess, about or a new enforcement manual. Apparently, I think it's talking about in the wake of the recent bank failures, that if you've got some problems, they're going to ensure that you need to fix them. One of the big challenges, or the big things that came out of the Silicon Valley Bank debacle, was the regulators knew they had issues, but didn't really address them enough to make it. I don't know if anything could have stopped that with the social media craze that went on to help sort of drive that bank out of business. But regardless, the OCC is on the case, and they're going to be really giving a much closer eye than I think what they have been doing.
Yeah, I'd be curious how much this is implemented, and kind of how aggressive they are, and some of the stuff in there, and like they'll have to close out lines of business and stuff like that. I feel like there's a PR aspect to this, and then there's a practical oversight and supervisory aspect to it that is going to be harder than the PR aspect of a manual and stuff like that. So I feel like there's kind of two things going on at the same time with this piece.
Yeah, I'm with you on this, Todd. I think this was total PR. This was a total cover your ass type of announcement. Like we screwed up. We've got these regulations in place. We just weren't enforcing them sufficiently, but we're going to do better in the future.
Mm-hmm. Before we go on, I just want to give a shout out to our good friend Tim Lee, who had this comment about when the overdraft credit card debt has going through $1 trillion, and yes, having that be that's, as you say, Ron, that consumers aren't necessarily getting financially healthier; they're just moving things around a little bit. So,
yeah.
Anyway, moving on, I want to talk about payments. There's an article in Forbes about basically the payments industry M&A, and we did see the recent announcement of Fifth Third Bank acquiring Rise Money, and there's been lots of other announcements here in the payment space. I feel like there's so much going on in the payment space. It just feels like there's just a lot of change happening. I mean, you've got FedNow coming out, you've got account-to-account payments, you've got all kinds of different payments rails that are coming out. So much change in the payment space. So it's not surprising that M&A is on the rise there.
And I also think going back to core businesses, PayPal's getting rid of Zoom, and others are kind of getting rid of, I guess you can call them ancillary lines of business, and they're kind of focusing more on this is what we are known to do well, and this is what we know is drives profitability. And so on top of that M&A discussion, you also have companies kind of going back to what they know and do best.
Yeah, it was a good piece. I'm glad you guys picked up on this one. Good piece by Daniel Weber in Forbes. And I think he covered the ground really well by pointing out that there's a lot of different reasons for these acquisitions. Some of it is streamlining of going back, as you said, Todd, to the knitting. But I think part of it too is because of the general downturn in the fintech valuations. It makes some of these startups a bit more palatable for a Fifth Third, for example, to pick up. So a lot of different reasons for that, but definitely one in terms of not just streamlining, but of trying to generate some scale, pick up some good technology assets. And I think we should be looking for a lot more of this in the next 3 to 6 months.
Yep. Okay, I want to go across the pond now and talk about the European Central Bank is finalizing prototypes for a digital euro. They seem to be well advanced of what we're doing here in this country. Interestingly, they're not necessarily using distributed ledger technology, but they are going to use some kind of intelligent kind of, they're not using smart contracts, but what do they call it? It was like some sort of intelligent way of having, directing payments. And it's going to be potentially a centralized system. Very interesting to see how this plays out. But the ECB, I mean, who knows how far we are from launch? I think it's obviously many, many years away, but they seem to be getting out there and really putting a stake in the ground, it seems.
I'm going to punt on this one, Todd. Let you you handle it.
It feels like, a couple of years ago, mentioning a digital dollar, digital euro without distributed ledger or blockchain would have been, unthinkable. And the fact that they went away from that and said that it doesn't really point to, being the best way to go about this project is, I think, interesting. They mentioned another system, UTXO, which is used in crypto as well. But I think the evolution of the digital version of money is going to be interesting, and in many ways we have it with the way in which money moves today, with real-time payments and other coming here and in other places around the world. So interesting, but it feels as if it's still a little bit of a ways off.
Right. Okay, we're almost out of time, but this came out just before we went on air, and I wanted to mention it. Stripe is getting into the credit card business. Now, they've had debit card issuing for a long time, and now they've got apparently 100 million cards out there. But now they're getting into the credit card business in the small business space primarily, which is their bread and butter. And so there's an article in TechCrunch. They broke the story. It just came out a couple of hours ago, and we don't have time to chat about it, unfortunately, but wanted to highlight it here. With that, anyway, Ron, wanted to say thank you for joining us. Todd, thank you as always. And of course,
thanks, Ron.
Thank you to the listeners and the viewers. We're actually going to be revamping the news show. So this is the last show of this current format. So we'll still be out every week late on Thursday, and look out for that. But appreciate your attention, and have a great weekend, everybody. Thanks. See ya.